We're all familiar with the traditional face of banking, but behind this there is a lesser-known industry called shadow banking. Estimated to be worth 24 trillion euros in Europe, the unregulated sector is now facing stricter rules to help avert another financial crisis.
Shadow banking, if I simplify, is essentially the list of activities and entities that are not banks, but that perform bank-like activities, such as lending or raising funding with deposit-like characteristics. Banks rely on shadow banking for their short-term funding for a significant part. So any shock in the shadow banking system has immediate repercussions to the traditional banking system, as we've seen during the crisis.
A draft law requires cash buffers to be set aside to avoid a panic should investors pull their money out. This is not a punishment, he says. It's about functioning normally. It means there must be transparency and good supervision, and that the risks taken by those in this sector, in this parallel banking sector, are subject to precautions. But there is more of a guarantee when there are more risks, he says. But users of the system claim the reforms would be too costly. The spotlight will also be turned on the shadowy sector at the G20 summit on Friday.